Hello, Mark Lloyd, Leader on Home Loans. This is going to be part 2 of debt to income ratio. Why is debt to income ratio matters? Debt to income is among the most important factors lenders use to evaluate loan applicants. For lenders, your debt to income ratio is a reliable indicator of your ability to repay a new loan in a timely fashion. Statistically, the higher your existing debt load relative to your current income, the likelier you are to fall behind on your service. Mortgage lenders are particularly cognizant of applications' debt-to-income ratios. Mortgage underwriters and the servicing companies that purchase most mortgages after they're issued have little incentive to issue risky loans to applicants who might struggle to meet their existing obligations. The lenders that do this, higher risk mortgages known as subprime mortgages, compensate for adding risk by larger demand of down payment and assigning higher interest rates. Subprime mortgages loans often require a down payment well north of 20% and charge interest rate of 8% compared to the 3 to 5% for prime mortgages. What is a good debt to income ratio for lenders? Front end and back end debt to income ratios. There are actually two debt to income ratios, one for the front end, your proposed housing payment, and then another for the back end. That includes all monthly debts, as we previously discussed. Some lenders may require you to stay below limits. In the example from yesterday, if your proposed monthly housing payment makes up $2,000 of your $3,500 in monthly liabilities, your front-end debt-to-income ratio would be 20%, and your back-end debt-to-income ratio would be 35%. Some banks and lenders require both numbers to fall under a certain percentage, though the back-end debt-to-income ratio is more important since it considers all your monthly debts and thus more representative of the risk you present to the lender. You may see a debt-to-income ratio requirement, say 30-45. Using our same example, a front-end debt-to-income ratio is 20% for your housing expense, only would be 10% below the 30 limit. Back-end DTI of 35 will also have a 10% clearance, allowing you to qualify the loan program, at least as far as income is concerned. If you own other property with a mortgage, it should be included in the back-end debt-to-income ratio because it's not part of the new loan you're applying for. Tomorrow, I will go over debt-to-income ratios for conforming loans, FHA, VA, USDA, and even Maine State Housing. Reach out to me at www.talkwithmarklloyd.com. Call or text 207-478-2065. Thank you.